All right, welcome. We're about to dive into the fundamentals of financial management. Whether you're just starting out or you need a really solid refresher, we've got you covered. We're going to break down the core ideas from that first chapter of the ICAI's textbook, turning all that theory into a practical guide for your CA exams. Okay, let's make this real. Imagine you're an entrepreneur. You've got this brilliant, game-changing idea. The vision is there, you've got the drive, but how do you actually get it off the ground? When it comes to the money, what's the very first thing you need to do? Well, as it turns out, it's not just one simple step, is it? Right from the get-go, you're making a whole series of really critical financial decisions. You've got to decide what assets you actually need, figure out the total investment required, calculate how much cash you'll need just for day-to-day operations, and then you have to tackle the biggest question of all. Where is the money actually going to come from? That right there is the journey from an idea to a running business. To navigate a journey that complex, you're absolutely going to need a compass. And for our purposes, that compass is financial management. At its heart, it's really all about managing a company's money to hit its goals. You can think of it as the science of money management. So what's the number one goal? It's to maximize the wealth of the shareholders. And we're going to come back to that exact point in just a little bit because it's super important. This little diagram here just simplifies it beautifully. Financial management really boils down to two key activities. First, the procurement of funds. That's just a fancy way of saying finding and getting the money. And second, the effective utilization of funds, which means putting that money to work to create some real value. Get the money, use the money. Sounds simple, but trust me, it's incredibly complex in practice. And that brings us to the three most critical decisions a financial manager has to make. I want you to think of these as the three major crossroads on our entrepreneur's map, the ones that are going to determine whether they succeed or fail. So, let's start with the first, most fundamental question that every single business, from a tiny local startup to a massive global corporation, has to answer. In the world of financial management, this is what we call the financing decision. It's that crucial choice of picking the absolute best sources to fund your business, its operations, and its growth. And as you can see here, you've got options. A lot of them. You can use your own money, you can issue debentures, get loans from banks, or maybe even find angel investors. Each one of these paths has its own costs, its own risks, and it totally affects how much control you have over your own company. Now, a classic choice you'll always face is between equity and debt. Equity, that's the owner's money. The upside, it doesn't have to be repaid. The downside, it's actually considered the most expensive source of funds because the owners expect a high return for taking on all that risk. Debt, on the other hand, is borrowed money. It's usually cheaper because the interest is tax deductible, but you have to pay it back no matter what. So the whole game is finding that perfect balance, that optimal capital structure. Okay, fantastic. You've made your financing decision, you've secured the funds, the money is sitting in the bank. So, now what? Well, the next major decision is all about how you deploy that capital to generate some real, tangible value. And that, my friends, leads us to the investment decision. This isn't just about spending money. No, it's about strategically committing those funds to assets that you believe are going to grow and generate returns for years and years to come. You can basically split this decision into two big buckets. First, you're allocating funds to long-term fixed assets. We're talking new machinery, a new factory, stuff like that. We call that capital budgeting. But at the exact same time, you have to manage your working capital, the short-term money you need just to keep the lights on. If you neglect either one, the business is going to be in big trouble. Okay, let's fast forward a bit. Your big decisions have paid off and the business is finally profitable. Now, this is a fantastic problem to have, and it leads us directly to the third and final critical financial decision. So what do you do with that profit? This is known as the dividend decision. It's all about figuring out how much of that profit should be distributed back to the shareholders, the actual owners of the company. And this one is a true balancing act. On one hand, you have to decide how much to pay out in dividends to keep your shareholders happy and reward them for their investment. But on the other hand, you have to decide how much profit to keep, to retain, and reinvest back into the business to fuel future growth. That could make their shares way more valuable down the road. So with these three massive decisions, financing, investment, and dividend, what's the final destination on our map? Is the whole point just to make as much profit as possible this year? The textbook is crystal clear about this, and the difference is absolutely crucial.
See, profit maximization is a short-term game. Wealth maximization, on the other hand, isn't just about this year's profit. It's about increasing the market value of the company's shares over the long haul. That automatically takes things like risk and the timing of returns into account. It is, by far, the superior goal.
Now, here is what's really cool. These three decisions aren't made in a vacuum. They're deeply connected, all working together toward that one big goal of creating value. But is it possible to capture this entire relationship in one elegant formula?
Believe it or not, yes, we can. And there it is. V equals F of I, F, and D. It looks simple, but it's incredibly powerful. It just shows that the value of the firm, V, is a direct function of its investment decisions, I, its financing decisions, F, and its dividend decisions, D. Those are the three big levers a manager gets to pull to drive the value of the entire company.
Okay, let's bring it all home. It's time to recap the key concepts from this chapter that you absolutely need to have in your CA toolkit. Okay, let's lock these crucial points in. At its very core, financial management is a balancing act between getting funds and using them well. Everything, and I mean everything, flows from those three interconnected pillars: investment, financing, and dividend decisions. And always, always remember, the true goal isn't just short-term profit. It's long-term wealth maximization. And it all ties together with that one big idea. The value of the firm is a direct function of these three choices. Getting this framework down is non-negotiable for success. So don't just think of this as theory you have to memorize for an exam. This is the practical guide, it's the map in the compass that you're going to use in your future career as a chartered accountant to make critical decisions that create real, lasting value. So you've got the tools. The only question is, are you ready to start building?